Hello and welcome to this Future of Finance discussion on programmable payments. I'm Bob Currie, contributing editor at the Future of Finance, and my guest today is Martin Hargreaves, Chief Product Officer at Quant Network. How are you, Martin?
Very well, thank you, Bob.
Thanks so much for joining us, and looking forward to getting our teeth into some of these issues in the next few minutes. Let's just start, Martin, by clarifying our concepts. Programmable payments. Just tell me how Quant Network conceptualizes programmable payments. What does that term mean to you?
There's a couple of elements of that. So the International Monetary Fund had a good definition of that. They make the distinction between programmable payments and programmable money. I'll start with what we're not, what we don't mean, which is programmable money. So in programmable money, that's usually a form of tokenized money, and the reason why people do that is they can put rules in the money to say this money can only be spent for these things. It may not be spent for these things. The controls go with the money. So if I pay you, Bob, some money that can only be used to buy chickens, say it's a special chicken coin, right? Then that's all you can spend it on. That's what programmable money is defined as by the IMF. Programmable payments is very different. It's just regular money. You can spend it on anything, but payments can be automated so that things can make basically payments on your behalf. So you can say, well, if this happens, like my salary's just come in, and every time my salary comes in, I want to pay my child a certain amount for them, right? But if my salary's late, I don't want to go overdrawn. So I just want it to happen when my salary happens. I don't want a standing order because that might take me overdrawn. There's those kinds of things. Being able to automate and set rules around what your money does for you, either as a person or as a company.
According to a set of triggers within the smart contract, so to speak.
Well, that's interesting, right? So that's the other. I mean, you've already brought me into the second question. So, a lot of the work that's been done on programmable money so far has been around blockchains and smart contracts. We've done some quite big projects with Bank of England, with some of the commercial banks, and kind of one of the learnings from those was that's great, but as a consumer, wouldn't it be good if you could just have programmable money on your bank account rather than have a special token version of money that only works with other people that can accept the token version of money, and that's programmable? Wouldn't it be great if all your money was programmable? You don't have to think about that. So that's kind of the big difference with how it's traditionally being defined, because it's usually like blockchain folks that are really into blockchain. Smart contracts is really cool, really cool stuff with smart contracts. We kind of took a step back and like, okay, that's fine, but for the person in the street, they're not necessarily on a blockchain. They haven't got a crypto wallet. They don't know any merchants that accept crypto or tokenized money. It's not even a thing in the UK yet. So what we thought was actually that this programmability needs to be in your bank account, because if it's in your bank account, then it works with the money that you've got. If somebody then adds crypto or stable coins or CBDC, and that becomes something that you can access from your bank account, that's great. Programmability will work there because it's on the bank account for you rather than out on a blockchain somewhere that you have to then jump through hoops to access.
So just sort of extending and looking a bit more deeply into that point of departure, therefore, you're developing a solution that in essence builds programmability into the customer account level, rather than that being built into the payment infrastructure, that being built into the payment rails. You're essentially sort of building that into the sort of source of value, if you like, the customer account. Is that an appropriate sort of summary of the key point of departure there?
That's exactly right. Yes. Yeah, yeah. So it's lifting it out of the rails, putting it back into the bank account, because the bank account is the point that sits above all of the different rails. So if it's there, you've got programmability across all of your existing payment rails plus any new payment rails, because it all kind of pyramids up to the bank account.
Let's just talk about how we got there, Martin. I know that just from looking a little bit at Quant's work in the past, you've been involved with a few public projects and BIS projects and such things. Just tell me a little bit about the origins and the evolution of the PayScript project, which I think is one of your sort of high level. It's how you brand it, if you like. Why was there a need for PayScript, and what were the primary milestones that have taken you to where you are now?
That's a great question in terms of, let's have a look at all of that. So we started off probably about 4 years ago now, working with in Latin America. So there's a public permission blockchain in Latin America called LackChain. It runs across 12 different countries. And as part of that project, we were working with the Inter-American Development Bank, looking to create basically a dollar stable coin that could just flow across borders across this network, but also connect safely between banks. So we ended up tackling a lot of the problems around how do banks tokenize that, and how does money move between banks? How do they settle? What happens if they're in kind of different countries? How does that all work? We kind of avoided the cross currency stuff because it was all in dollars, but there was a lot of learnings in there around how to build that. And we built basically a tokenized dollar with a separate settlement network across these different countries. That led later on to the BIS project that you referenced, Project Rosalind, which we were hugely privileged to be involved in. So that Rosalind was a real landmark project. So there's two types of central bank digital currency, or CBDC, wholesale and retail. A lot of the previous work had been in wholesale, which means it's money, but it's only for banks to use with other banks or really large companies to use. Rosalind was the BIS and the Bank of England wanting to prototype what a retail CBDC would look like for the UK. And it was a fascinating project. It was a really good project. The teams from BIS and the Bank of England were fantastic. And we ended up building out a really big simulation of what this could look like with a bunch of banks, a bunch of other folks. So at Quant, we built the ledgers because we wanted to try two different ledgers. We built the API for how to interact with this. And we had several commercial banks. Barclays were involved, Revolut were involved. There's lots of folks were involved. MasterCard were involved, checking kind of how usable is this and how does it work. And the bank were looking at effectively an experiment to try and validate some of the policy questions that they had. So what happened in Rosalind is not necessarily what a CBDC will look like. This was an experiment for them, but it was a real milestone because no one else had really done this. This was a live infrastructure that people could come and test on, build applications against a retail CBDC. And one of the questions that came up there is like, why would people use this? Why is it different from just normal money? Right? People in the street don't really appreciate or care about, or should have to care about, the difference between central bank money and commercial bank money. So what's special about it? So we gave that some thought, and it was pretty clear that programmable money wasn't going to be the answer. There was no political will and no particular reason to encumber money with rules and things. So we wanted to make it more interesting. So some functionality was developed in Rosalind around a thing called a three-party lock, which is a bit of a incongruous name because it's actually quite a cool thing. So what a three-party lock is if we imagine a scenario where Bob, you're a builder, say, and I've hired you to make build me an extension. Okay, so you've built the extension. You know you want to get paid. So at the start of the contract, I lock the money. The money is locked that will be paid to you when you finish the extension, right? I want to make sure it's good quality. So I'm not just going to go, yeah, that's fine. I want to hire a surveyor. And the surveyor says, yeah, Bob's done a great job, you should pay him. We automate all of that. So the money is locked. The beneficiary is set up ahead of time. And for the duration of the work, the money is there. So you know you're going to get paid if you do a good job. The surveyor basically comes along, and then there's an API for the surveyor to say, yeah, Bob did a good job, release the money now, and you get paid. So that's kind of a very consumer example, but that applies to lots of things. So that could be a big software project, it could be audit, it could be payment on delivery for goods between people that don't know each other, which is really how that is being taken forward, because it eliminates a lot of authorized push fraud. So in that scenario, you're the third party. The first party is me, I'm paying. Bob, you're the second party. Surveyor, you're the third party. And that was quite a novel thing that's not been done before. So that was an innovation at the time, and it addresses authorized push fraud, where if we don't know each other, we meet on a peer-to-peer marketplace. I pay you to sell me something, you don't deliver it, you've still got my money, or you do deliver it, I claim it never arrived, and I get a refund, and I've got your money. None of that happens. So when it's delivered, I sign a thing, the delivery company then sends the money. So the possibility of fraud kind of is taken out of that, and that's tens of millions, I believe, in terms of that kind of fraud that can be eliminated. So that was a nice milestone. During that thought process, we thought, oh, there's more we could do here. But in the constraints of Rosalind, which was a very short project, it was a great project, but it was very rapid iteration. There's more we want to do. So the following year, the UK Regulated Liability Network project came up, and we were privileged enough to be one of the vendors working in RLN. So RLN was, and in fact is, almost like the commercial version of this. So rather than tokenizing central bank money, it was interested in tokenizing commercial bank money and interested in programmability and orchestration of complex payment flows, and looking at what are the technology choices to do that. And there we extended to build kind of a back-end workflow engine. So RLN was quite a complex project to massively understate it. There was about 58 different types of flows between different types of monies and settlements. But we extended it to include other types of locks. So what we have multi-locks. So you can say, well, I want all of these people have committed to pay, then the payment will happen. For like bill sharing between students, or bill splitting in restaurants, or house moves. So that was one of the things that they looked at using multi-locks. Split payments, and building out kind of the functionality that would form the basis of the ability to program things. From there, we looked at, that's fine, but I'm not sure it gives the banks that we're talking to what they really want. So what they really want is to be able to program this themselves. So rather than build an infrastructure that says, here's a bunch of programmability stuff, you can use it, here's the API. How about you could actually just write your own customizations, your own programming directly into it? And so we thought about that for a while, and we thought that's fine. But back to the first point, the payment rail isn't the right place to do that. The bank account is the place to do that. You can do it on the payment rail, but it would only work for banks that are connected to that payment rail. And the thing with payments is it's either ubiquitous or you've got nothing, generally. Because as a layperson, if I want to send you something, we both have to be members. So if 50% of the people are members, that means half the people that want to send are, half the people that want to receive are, only 25% of the payments can actually go through. So ubiquity is really important.
So that was the origin of what you moved into, sort of domain-specific languages in the building blocks that you had to be able to customize it more to the customer account level. Is that right, Martin? Or
exactly. So we moved it up, and we said, okay, if we're in the customer account, what do we want to be able to do? And this is something that we'd thought about for these projects previously, but they hadn't been in scope. So what we thought would be the right way to do this would be to attach programs or scripts or automations, however you want to call them, directly to the customer bank account. So when I go to my bank account, I can see, well, here's my balance, here's my overdraft, here's my direct debit, standing orders, and here's all the automations I've got on my bank. And that led to the question, okay, so what's the format of an automation? And we've got a lot of payments people in Quant, so we're like, okay, we're designing this for payments professionals. They're not developers. They don't want to be writing it in Java necessarily. So we'll create a high-level language that you can write these automations in, and then you can make them available directly to customers, and then they can basically fill in the form that says what you need, and the automation attaches to their bank account. And by doing that, you can basically speed up the level of innovation that you can create massively, because you no longer need large teams. You don't need developers. You can basically get people that know about payments, your business analysts, product people, directly creating the code for these use cases in this really high level language, so make it really, really accessible.
So that's not quite a low code, no code approach, but it is a high level language. So it's pretty accessible to the customer.
Exactly right. Yeah.
You've talked about a series of triggers and how, if these triggers are satisfied, a payment will potentially be exercised. How much flexibility does this domain-specific language setup extend to you? I mean, there may be other things you need to build in there, the sort of KYC elements and some information that's needed to, determine whether a customer is eligible. Then for, some information that's needed for onboarding the customer. There may be some sort of fraud detection in there. What sort of consent mechanisms have you been able to or offer to the customer to build into the contract using this domain-specific approach?
Ooh, that covers a fair amount of ground. So
in a nutshell, Martin, doesn't need to be long.
There's two areas to that. So consent between customer accounts, there's a few things. So one of the use cases is, say, I've got a child who's away at university. I don't want them to keep going into their overdraft. So every day I want to check if their balance goes below a certain amount, I'm just going to top them up a bit. I don't want to have to do it. I want my bank account to do it for me and tell me if it's happened.
Yeah.
So for that, the student then has to consent for my bank account to check their bank account's balance. So it's that kind of thing. So for each of the things that we do in the language, there's a consent flow. And if you want to, get all the transactions from account, the account owner has to give you consent to do that. If you want to run another automation that's on their account, because maybe that does a whole bunch of work and then just gives you an answer to say, yes, they're in good standing, it's fine to do business with them, something like that, then you need to give permission to run that automation. So we've done that. We have mapped that consent framework onto the open banking consent framework. So we're really conscious that this sort of stuff does not want to involve banks having to do 5-year implementation projects. So we made it as compatible as possible with standards that are out there. So it works with open banking. It is improved if it's done in the bank and connects to their internal APIs, because there's more they can do that they don't expose through open banking. So that's how consent works. The other part that you mentioned was around KYC and AML. And to be honest, there's no change there. So what the pay script will do is trigger the transaction. The transaction will then go through all the bank's normal checks and balances. So if it's high value or it's a new payee, all of those journeys will continue to work. There's nothing that changes in there. So it retains all of the security that's currently in place for those for customers.
Perfect. And you've alluded to some of the triggers there. I mean, one that you've just touched on in your student analogy or student metaphor was obviously one with, a cash flow trigger.
Yes.
Trigger. If the account falls below or above a certain threshold, it may trigger. Is there other elements? I mean, for example, could you send an instruction via an API to trigger a payment? What does this encompass?
So there's a few different triggers. Absolutely, the API trigger is one, and the way that works is for that specific script. If it has an API or a webhook trigger, it's called. Then when the customer presses yes, I'd like to put this on my account, it's all set up, then that's created dynamically, and that lets other things that the bank is allowed to kick that script off. Basically, there's an endpoint that says when you hit this endpoint, that will happen, and that's super important for building front ends. So you can build all this logic at the back end with pay scripts, and then the front end web GUI or mobile app can just ping that API, and all the data from the pay scripts will be there to populate the UI. The other things that we have, there's time triggers. So you can say, I want this to run every day, I want it to run every 5 minutes, I want it to run on my birthday, however you want to do it, that's very flexible. We mentioned the balance trigger. So if the balance changes, goes above or below a certain amount, take an action. There is also one called a payment trigger. So if a payment goes in or out of your account, that might do something. So an example for this is a small business example where you're getting payments from customers. You're going to have to pay VAT. You're busy and you don't have time to keep an eye on your bank account the whole time. So every time money comes in from customers, that triggers a payment transaction, and 20% of that can be sent off to a savings account. So you don't even think about that, but in the meantime, your VAT is there and not accidentally spent, which can be a huge issue. But also, it's been earning interest the whole time because it's gone to a high interest account rather than just sitting in your current account. And again, you didn't have to do anything; you set it up once, and it just works. And every payment that comes in will trigger it. The last trigger on there is, as well as being called as an API, PayScripts can call out to other APIs. So you can do things like call this API, and if the value I get back meets these criteria, then run a script, which could be something like, I'm kind of interested in buying euros, but I only want to buy euros if they go below a certain level. So every day, ping the exchange rate. If the exchange rate goes below a certain level, automatically buy it and just send me a message saying, I've got your euros and this is what you paid for them. So it's those kinds of things. So there's a lot of flexibility in the triggers.
That's really interesting. I mean, I want to come back to that point. I'm just going to talk a little bit about interoperating with other systems in a minute. But before we've had quite a nice sort of detailed look now at the mechanics, and hopefully that's useful for the viewers and listeners. Maybe we can just step back a little bit now and just look at the business case and the consumer impact. I mean, what benefits have you identified from a sort of a quantitative or a qualitative standpoint, in terms of cost savings and potential time efficiencies this may offer to the user?
So that's been a little eye opening for us, actually. So we've been looking at kind of the FCA's work and the market research that's out there, as well as our own market research. And in terms of late payment fees, overdraft fees, and missed opportunities for people to be earning interest, it turns out the difference between a well-optimized bank account and how most people run them today is about £1,500 to £5,000 per person in terms of overdraft fees, late payment charges on bills, and interest that people could have been earning. And so that's kind of, we've got that from industry. We'll put the references on our website, obviously. On the corporate side, it was even more startling. So for kind of mid to large size company treasuries, the amount that they were missing out on was kind of ranged between 500 and 700,000 a year. So it's quite high in terms of the potential benefits of automating and optimizing your bank account, whether you're a company or a consumer. In terms of the business cases for banks, I think that's really important, because some of the feedback we've had from banks is there's a lot of things that they've been asked to do where they haven't necessarily seen a commercial case for it. If you look at open banking, VRP, then really not sure about the business case for them or for CBDC, that kind of thing. In this case, we've looked at what would people be willing to pay for this? Would people be willing to pay more for a bank account that could do more things? And the answer was yes. So depending on kind of the number of automations you add to it, you can create different tiers of bank account product. So for the banks that we're kind of offering this to, there's potentially a huge upside in kind of new revenue, which is kind of non-interest revenue as well. So yeah, we're very bullish on the business case for doing programmable payments and optimizing bank accounts.
Those are quite striking numbers. You say 1,500 to 5,000 sterling for a retail account, and you're talking 500 to 700k for a corporate.
It's high.
Yeah, that's that's an interesting point. I mean, I think Quant's prepared a white paper which it may be possible to share with the viewers that maybe provides further detail on this.
Yes, it does.
One thing that, you know, one stands outside looking in through the window as we do, we see a lot of proof of concepts. We see a lot of launches, not specifically in programmable payments, but across the tokenization world. And often technically the POC looks fantastic. They've got their early adopter clients on board. It all looks great, you know, but then we monitor it for 3, 4, 5 years or however long the time frame is that it's been in existence, and it's done well. But, you know, sometimes the growth trajectory can be, you know, can be slightly slower than we might have anticipated, given the prospective benefits this appears to bring to the table. What do you identify being the sort of potential challenges to adoption, and are there specific enablers maybe that, you know, will be important and valuable to make this fly?
Absolutely. In the payments world, there it's adoption is always an issue. So the biggest thing I think is going to be around education and marketing and getting people to understand this. So this is and we see this as kind of it's a whole new way of dealing with money, right? I mean, our CEO talks about it being a new kind of money. So it's very much a paradigm change, and people need to get their head around that, and they need to be able to trust it. There's a lot of AI around there. People have different versions of that. PayScript isn't AI, but it easily plugs into AI type systems. So this is really about getting consumers and businesses to understand what the benefit is, understand risks. Are there any new risks? How are their banks managing the risks if there are new risks? And being able to kind of have a go. The other side of this, I think, which helps with adoption, a lot of particularly in the blockchain world, but the same thing applies to payment rails, is though they require network effects. It's the same thing I was talking about earlier. You kind of have, if you're in a business model where you need a network effect, you've kind of got ubiquity or almost nothing. Yeah. So even if you've got 80% adoption, yes, 40% of transactions still aren't going to go through. So that was part of the reason why we designed the way we have. So if you are a bank and you want to do programmable payments, you don't need all the other banks to join in with you. You can run PayScript, you can offer it to your customers, they can enjoy the automation. It will work with other banks' customers using open banking APIs, and open banking is already ubiquitous. So we've deliberately designed it so that we can scale without requiring a network effect and without requiring ubiquity. So as a customer who's using programmable payments, it's not required that everybody else you deal with also uses programmable payments in the same way as it would be for these blockchain type projects. You know, you can only transact with other people who are on their network. So we think that is kind of takes that blocker away from adoption, in that actually you can, an early adopter bank or a bank that wants to be more innovative or wants to compete with fintechs can go first with this. They can bring the benefits to their customers, and as I'm sure you know, banks tend to move in herds. They'll wait and see if it works out, and at that point, kind of adoption come up. But it doesn't require everybody to go at once in the way that payment system would.
And by that fact, one assumes, therefore, that, you know, some of your customers and prospects in the banking world won't need to replicate, you know, a full global banking or payments infrastructure internally. Obviously, they will API out to existing systems. You know, some of those are quite new and quite sprightly, and some of them, you know, maybe are getting a bit long in the tooth now. You've got different levels of maturity, and you're having, as part of that network that you build through, you know, through API or other forms of interoperability, you know, you've got a different set of maturities there. Does that present any difficulties just in terms of getting stuff to talk to each other and making that sort of AI API based network, you know, work efficiently?
It
Or pre-API based networks even
well,
as well?
not difficulties, but what we what we'd call a solution opportunity. So the way that PayScript works, underneath the engine that understands the scripts, there's this interoperability layer, which we call the execution layer. And what that does, that has individual modules for everything it connects to. So it can connect to open banking, it can connect to a bank's core banking system, it can connect to other external payment rails. And in there, what we will do is we will attempt to bring everything up to a standard, right? So if there is, if we want to do locks and a bank wants to do locks, they don't have the ability to do locks in their core banking system. Locks are already in there. So there's an enrichment of the underlying payment rail that happens in the layer just underneath the pay script, so that the scripts are more functional and can do more things. The other aspect of this is that the pay script language, there's a core to it and there's a lot of optional things. So if you are a bank that has a really wide range of services and you've got loads of stuff, what we will do with that during the implementation is all of those will just become keywords in the PayScript language. So all of that becomes available. If you're a bank that only has minimal capabilities, some keywords won't work because you don't have the capability to do that. Some will because we enrich them at that execution layer, and some are kind of core and they work. So the idea with that is that we don't force you to do anything. We don't force you to upgrade. If you've got all of these things and you're well differentiated, you capitalize on that. If you're further behind, you don't need to do a £10 million infrastructure upgrade to do this. We'll just scale it back to the capabilities that you've got at the moment, and then it will grow in line with your natural growth. So we're one of our kind of big design points is we don't want to cause our customers pain when they're trying to get benefits.
Indeed, that's useful. Thank you. I mean, we can touch on that, but I mean, one thing I just wanted to talk about, in terms of when we're talking about contracts, there's obviously a legal component in there. How far have you faced sort of legal complexities and had to work with, work with the lawyers just to get that sort of clarity that always sits around trying to make contracts electronic? Over time, whether it's in securities, whether it's in payments, we've got issues of finality. There's consequences for dispute resolution and how these are treated by the courts. Whether there's sort of cross-jurisdictional differences in cross-jurisdictional treatment of how your domain-specific languages may be understood. I mean, how far have you had to work through these with the lawyers to get these all clarified to move to this point?
So there has been quite a lot of work on the regulatory side, because, like I said, for the last few years, we've been developing new payment instruments, locks, split payments, multi-locks, all this kind of thing, and they are quite complex in their regulatory treatment, some of those, and so we've spent a long time looking at those, so we're able to advise what works and what doesn't for a lot of jurisdictions. In terms of the kind of commercial contracts between customers, because we've done this at the bank account level, and not on an external network, we've kind of bypassed all of that. So we are within normal business legals, effectively. So what the pay script does, and this would be covered by your T's and C's with your bank, you're authorizing it to act on your behalf. So it's an automation that's acting as you, and it's executing any contractual obligations you've got as you from your bank account. Where you have got a contract between you and someone else to say you're going to pay in these circumstances, you can code that up, but it's just acting on your behalf. So compared to something where people are tokenizing into a network and there's a smart contract which is trying to enforce stuff, the smart contract is acting as a third party with an unknown / questionable legal status, which is trying to enforce things on people in the real world. We don't do that. So effectively, they act as you, as Bob, the natural person in the real world, has asked his automation to do these things. Bob is still accountable for what he's accountable for, like he always was. Bob's bank is accountable for what they are accountable for, like they always were. So to a large extent, a lot of those problems kind of disappear because we're not introducing this legal pseudo person who is a smart contract but is also code and might have bugs and someone needs to be liable for it. It's all fairly clear because we're kind of building on what we have today but making the accounts much smarter.
So there's no sort of significant constraints you see at this stage in terms of moving that forward. That's
no.
That's work that's been done, so to speak.
Exactly. Yeah.
Thank you, Martin. Just in sort of moving this forward now, and I'm going to talk to you a little bit about the timeline and how you see this playing out before we close. But I mean, clearly one thing that we've chatted about in the past was that part of your challenge is the need to ensure compliance with existing regulatory frameworks, But then we're seeing sort of open banking consent models and open banking frameworks sort of moving forward quite quickly as well. You know, and what are you needing to do to sort of marry those up? You're needing to sort of forward look to see how those sort of open banking standards and networks are going to move ahead too, and you need to sort of align yourself with those, presumably.
Absolutely. So yes, we're all over that, but we're actually quite proactive about that as well. So our work on the PayScript consent model has thrown up areas where we would love to see open banking be extended. And then so we work through our trade bodies, through Digital Pound Foundation, UK Finance, to try and influence policy on that point of view. So we are there on every consultation. We have strong views about where we would like this to go, because it enables the product. It enables more things to happen within a safe framework that has regulatory backing, and it just makes everything a lot clearer. So there's advanced functionality that's kind of still to come, which is reliant on some of those changes to things like open banking and the payment regs. So yeah, we're very strongly engaged on the regulatory side because we have a vested interest and a real stake in it.
Perfect. And just tell me a bit more about, you know, the rollout going forward and how you see this playing out, the interface with the clients and prospects, and how you see this growing over, you know, years 2, 3, and henceforward.
Absolutely. And this is a bit that we'll have to check internally, by the way.
Sure.
So we are launching the product as Quant Flow. So Flow is the overall platform that includes PayScript, includes execution, and there's a couple of variants on that. So the first thing that we're doing is launching a sandbox. And sandbox is a funny word because sometimes it means a regulatory sandbox where rules are suspended. We mean a technical sandbox. So we're really aware that this is very new and people need to get their head around it and they need to play with it. So what we've created is basically it's a web application that lets people write pay scripts, and it's got a simulated country's banks in it. So you've got 4 different banks, you've got the customers of those banks, their bank accounts, you can act as each of those customers, you can see what they would see on their online banking. That includes all of the automations. You've got a developer view where you can write pay scripts, you can upload them, you can set them all up. It will create the webhooks that you need to create front ends, all of that. So that's the first thing that we're bringing to market, and that will be early Q2 for the sandbox. And this is what I need to check because we might be launching everything at the same time, even though not all of it's ready. So edit. Then following that, there are a couple of live products. So QuantFlow for banks is a white label product. So banks can embed our product in their infrastructure. And there's a couple of versions of that. So the way we see the journey going is have a go with the sandbox. This is really awesome. The thing you can do with the sandbox that you couldn't do before is if you're a payments person or you're a payment product person, you've got a really good idea for an application that could make money. How do you prototype it? What would it look like? You can go on the sandbox, and we've done this, and it took us about an afternoon with me doing the PayScript side and my colleague doing an AI generated front end for it just to build the whole thing. So an afternoon to build out the prototype for this. Take it back internally. If it's a good idea, then you get budget, you get funding, and you want to build the thing. So the first thing that you would then get is a small instance of QuantFlow that just does your one use case. So you don't need to buy everything. It's relatively small. It does that. We'll help you with that, and we'll help you get it all going. If that goes well, and then you think, okay, this is great. This took me like so much quicker, and I'm making so much money from it. I want to do more. Then the next one after that is that's fine. We'll just kind of open that up to the large version where you can have as many different use cases as you want, as many customers as you want, and that's kind of how the product line goes. Kind of sandbox, single use case, all the use cases. Those are again Q2, Q3 release, but
so they're very imminent. I mean, we're talking over the next 6 months or thereabouts for those rollouts.
Yes, and yeah, let me restate that for the point of editing, so I need to check with sales. So we will be launching everything is coming in the next 6 months. The sandbox will be the first thing that launches, and that will be available early Q2.
Is there anything else in Quant's pipeline, Martin, that dovetails with this that we should share with viewers and
well,
and
a lot of it there is, and we'll share it when we can. So we continue, as we were active with LackChain, which was a large project with 12 countries, with BIS and Bank of England, with RLM with the banks. That's still a stream of work that's ongoing. So we are still looking at other projects with other central banks, with groups of banks, and in the kind of next generation and programmable payment space. So those kinds of strategic projects that kind of push the industry forward, we'll still be at the forefront of those and continue to push the industry forward.
Thank you, Martin. It's been most fascinating. So thanks for joining me this afternoon. And I also encourage Future Finance viewers to tune in to other podcasts and interviews that appear on the Future Finance website. Good afternoon, and thanks very much.